Hi folks, welcome to this short lecture on share retirements and share splits. Now, in this question, first of all, you'll notice in the video I have given you the title of the question or the number of the question from your textbook, so you might find it very helpful to have your textbook in front of you or at least your ebook on the screen so that you can follow the question that I'm preparing the solution for here. So in this case, the first thing we notice is that the company in its original equity section of its balance sheet at the end of the year had common shares of 200,000 that were issued and outstanding and got 2.4 million from investors from the issuance of those 200,000 shares, and we also have retained earnings of 400,000. During the year, we repurchased and retired shares twice, and then there was a share split declared. So what we need to do is we need to do journal entries for all of it. So now, on April the 15th, what we noticed is that we repurchased and retired 15,000 common shares, and to retire them, the company had to buy them back from investors at $10.40 a share. So the first thing you need to ask yourself is that $10.40 per share greater than or less than the average issue price? In our case, the average issue price of the shares issued are right over here. Our investors gave us 2.4 million and we gave them 200,000 shares. So we know this from our original equity section. So we know that investors on average gave us $12 per share to buy those shares for all the time that those 200,000 shares were outstanding. So we bought the shares back from them at a price that was less than that. So that means to us that the market price of the shares have come down because we would pay the investors $10.40 to buy them back, which would be the market price. So therefore, we're going to credit cash for $156,000. That's what we paid to buy back the shares. But we're going to remove shares on this share retirement based on the average issue price, because that's what we recorded in our common share account, $2.4 million in money received for 200,000 shares. So that means on average we're removing those 15,000 shares from our books at the average issue price. So we're going to debit the common shares for 180,000. So because we paid less to investors to buy the shares back than what investors on average gave us, which was $12 a share, we now have a $24,000 credit. This credit is not a gain. A gain is like an income statement thing. We're doing an equity transaction, not a revenue or expense transaction. So we call it contributed capital. And our contributed capital is created as a result of the retirement of common shares. Now, on May the 1st, what happens is we're going to retire 25,000 common shares, but this time we're paying $13.60, which is more than the average issue price. So now we're going to credit cash for what we paid to buy back 25,000 shares, which is $13.60. And we're still removing the common shares from our books, those 25,000 shares, at the average issue price of $12 a share. So that means that our common share account is going to be debited for 25,000 times the average issue price, which is 300,000. So now we're a little light here on the debit side. So what can we do? Well, we can go to our good buddy contributed capital and draw down on contributed capital, but only to the extent that we need it, and only from contributed capital that exists as a result of a common share retirement. If we were retiring preferred shares, for example, we couldn't draw down on any contributed capital that was created or previously existing, because that's for another share class. But we do have some contributed capital from common share retirement that we created, which is $24,000. We didn't have any contributed capital in the equity section of our balance sheet. You can check that in the question. So the only contributed capital we have on common share retirement is what we created on April the 15th. Well, that's not sufficient to balance our entry. We can draw down on it, and the rest comes from retained earnings. Now, on November the 1st, we had a transaction, but again, it's a share split. And with the share split, because there's no change in the balance of the common share account, we don't make a journal entry for it. We will make a note disclosure, however, that we are splitting the shares, and this would be a note disclosure that goes in the notes to the statements, and it would say that we had initially shares of 160,000 that we split 2 for 1. Now, how do we know we even have 160,000 shares? Well, one way that we know it is we know that to start, we had 200,000 shares. That was given to us in the question. But we know that in our transaction on April the 15th, of those shares, we retired 15,000. And then on May the 1st, you can see here we retired 25,000 shares. So that's going to give us 160,000 shares that are available to be split. So now, I'm just going to put here, available for split. And they were split. They were split 2 for 1. So that now means we have 320,000 shares outstanding. So now when we do the equity section of the balance sheet, you can see that what happened is that we have 320,000 shares issued and outstanding because at December 31st, that's after the date of the split. You can also see here that we have $1,920,000 in common share equity. How did we get that? Well, we started our question here, you can see, with $2.4 million in equity. But don't forget that on April the 15th, we repurchased shares that were on our books at $180,000. We did that up here, so we debited common shares. And on May the 1st, we also debited common shares based on the book value of the 25,000 shares we retired, which is at $12 a share. So that leaves us with $1,920,000 in common share equity. Now, retained earnings also changed. Why? For 2 reasons. Number 1, when we retired some of our shares on May the 1st, we had to draw down on retained earnings to balance our entry after we had drawn down on contributed capital. So of the original $400,000 that we had on retained earnings, we drew down $16,000 in our May 1st transaction. But we also see from the question that we had $136,000 in loss during the year. And because we had a loss, when we closed the income summary account, we would debit retained earnings to record the loss to reduce retained earnings. So we're only going to have $248,000 in our retained earnings at the end of the year. And that's going to give us total equity of $2,168,000. So this concludes one of the questions that we did on share retirements, share splits, and preparing the equity section of the balance sheet. I hope you found this helpful.